Hello, thank you for coming on board with this power session for November 2022. Before we put you straight into that video where we'll be looking at a whole range of markets, as we mentioned, we'll be looking at Bitcoin, what's next for that, we'll be looking at the dollar index, a whole huge cross section, oil, gold, silver, which grain's about to move, copper, what's next, etc. All those bits and pieces. And what we do is that I'll be talking to my friend and colleague Ray there, which you'll see this just within a few moments. But I want to give you a quick overview of the platform that we're using so that you understand exactly what's going on. And here it is. So what we're going to do here is just give you, as I say, a very quick overview. And what you see here is that we cover around about 40 instruments here. And this is all about the commitment of traders' data. So this is what all the smart money is doing. And we also get to see what the dumb money is doing. Now, there's quite a lot to this. And for those of the people, those of our course members or that are members of our monthly sessions, they get the full course and all the bits and pieces behind that. But by quick overview, what we see here is a list of all the instruments. And we look to see what the smart money is doing, as I say. And what happens is that we then apply a series of filters, and we've got a proprietary indicator. I'll give you a quick view of that in a moment. But at a quick glance, we can see anything that has low numbers here in light mauve is looking like a potential short move. It just draws our attention to it. We've still got to go and analyze the market. And anything that has the 100%, 95 or above, is a potential long situation. So that's a very quick sort of overview of that. But also within here, you'll see some flashing numbers, and where they're flashing, that's where we've seen very large changes in positioning between, say, the commercials, non-commercials, etc. And as I say, all these groups are covered, and it helps us identify what the smart money's doing and what the dumb money's doing. So again, this immediately alerts us to where to look for what's coming up. Additionally, within any one of these areas, we also show seasonality, and one of these that's come up. The session you're going to get was filmed on the last trading day, which is Friday. It's actually Sunday, the 20th of November. Right now, we filmed this on Sunday, and of course, the commitment of traders data gets updated on Friday night UK time. But one of the things that's happened is that random length lumber is now generating all these very high numbers here. It's got flashing numbers, and that's suggesting it might be moving into a buy signal. But if we go along here, we can also click on any one of these, and we have the seasonality for all these different instruments. So what we're seeing is that seasonally, and we have regular seasonality in blue, which is probably what you can get from several people, and then we have our own proprietary seasonality where we've tweaked it, and again, we show the formula of what we do within the course. So what we see here is that all this shows that we could be potentially moving up into a very bullish December in lumber. Of course, we ultimately trade the market. So that's a quick overview of that page. Also in here we have what are called COT extremes, and in the video you'll see the data we used, which was just updated on Friday night, didn't have any all-time lows or all-time highs for last week, but this week we're seeing these. So again, it shows that these are markets that are really worth paying attention to here. And of course, lumber's one of these as well now. So what we're seeing is the smart money has its lowest level of shorts. So that's a very quick overview. We'll talk through it again in a moment. But here's the whole power session, and I know you'll enjoy it. Not only will you enjoy it, you will find it very useful indeed, and you'll see what we believe is coming up ahead on the radar. And we do these sessions every month. So go ahead, enjoy what's coming up. Hello everybody, it is Friday the 18th of November. Welcome to the November power session. Very interesting week. Lots of stuff has been going on. We hope you caught the crypto moves. They were foretold by the platform. Lots of good stuff going on. So also I want to extend a special welcome to those people who are joining us today, the new people on board, and also some special guests that we're inviting in to this session, so you can see exactly how to benefit from this very powerful platform, which really does give you a whole series of ideas of where to look and what to look for in your portfolio management and trading and investing. So without further ado, it's over to Ray. Ray, thanks for being with us again. And Lots to talk about this week.
Indeed, yes, Andy, and thanks for having me on. One thing I will say before we start is it is Friday. It is Friday. The new data, this week's data, will be released tonight. Well, tonight UK time, and I am eager to see what that data has in store. The reason being is if we consider the moves that we've seen last Thursday, after the CPI data come out, we've seen big moves right across the board. But we're pretty much confined just to Thursday, but there was big moves. The current data we're looking at doesn't contain the trading activity that would have happened following that release.
Yeah.
So tonight's data will be the first sort of time we get to see what's actually going on. Have traders reevaluated their positions since that data? Have they put money into certain markets? Have they taken money out of certain markets? So we get to see that. So we'll be looking for the position changes. Has there been big influx into certain markets or a big reduction in others? Things like that I'll be looking for tonight. I would say, given the moves that the lack of follow through that we've seen in the markets since, whether it be equities and forex and bonds, etc., the lack of follow through would suggest that there hasn't been a complete revision of positions, and traders haven't went from being short one to be absolutely long in that market. So I'm not expecting to see many with huge changes. Otherwise, we would have seen a follow through. The fact that we haven't, it may have actually just used those short-term moves last week to actually get more short or more long, depending on which side they're on. So that's something to look for, and I will be spending the time over the weekend to go through those numbers to see has there been a positional change. Somewhere where we have seen a positional change, and we'll start with is crypto. Before the decline, actually, that was before the CPI data related to that. Before the decline, we did see a positional change in crypto. The commercials got cutting longs and adding shorts, particularly if you look at Ethereum, that had got relatively bullish over this last number of weeks, where we've seen an increase. We just isolate, you can see the commercial longs here in Ethereum within this sort of the previous rally going back a few weeks ago. And they completely disappeared last week. You can see at the top of the platform here, you can see 77% decline in their positions, and that was pretty much going from bullish to bearish instantly, and cutting those. Bitcoin, not quite as dramatic changes, but you can see they cut their longs, added into their shorts. So there was certainly an element in there where those commercials within the crypto sector were anticipating or hedging for decline or positioning themselves for decline. The Bitcoin micro chart, they've been bearish throughout and held that a very bearish long position in there. So the stance, even though we've had a decline, and I know you've said we're in the window now for the end of the current bearish cycle and to actually make a low to head into the next halving cycle, and we are slap buying in that window for it. So I'll be interested to see, do we start to see an increase in longs again over the next couple of weeks? If we can get to do that, and I think if we can get above 18,000 again in Bitcoin, and I think it is possible that a low could be in. I would have liked to have seen Bitcoin to go around 14, sub 14, somewhere between $13,000 to make that low, to then turn to move higher. So it may be a little bit early yet. We may have a little bit more downside. We'll see how the positions change over the next couple of weeks. But I think we're getting close to a low and the beginning of that next halving cycle. Whether we're right there or not is the gray area. So I'm planning to be long. I'm not long yet, is what I'm saying. But short-term traders, I would stay on the short side unless we break above 18,000 in Bitcoin, and I think then that confirms that the low is in.
Well, yeah, and I think if we look at the November market timing report, a couple of things to note. We gave you the date of the 8th, and I think the low came in on the 9th. And most importantly, and this is really, really important, the cycles that we are seeing, which I'll be covering in the report that comes out at the end of the month, are suggesting that it's a very important turning point coming up at the back end of the the first week of December, around about the 9th, I think it is. Those cycles are tremendously strong, so I'd be very surprised if we didn't see an inversion there. So I'm not going to say it's a low, but the odds favor a low. What we do want to do is look to see what the market's doing and what Bitcoin and the cryptos are doing as we approach that window, and then look for a reversal there. I mean, if for any reason we shoot up in the next few days and the last 10 to 12 days of November, then we could well see a high there. But watch out for that, a very important turning point date. And that in itself will act as an anchor point for those of you that are using all the techniques and the market timing report trading course. So that's a very important window. Back to you, Ray.
Yeah, the timing of that would be nice, given where we currently sit. I would still like to see a little bit further to the downside. That window that you're saying about the 8th of December, that gives us a couple of weeks to allow commercials to reevaluate the sector and actually maybe see a positional change and actually see buyers start to return into that, commercial buyers returning in. That would be a nice strong indication that that low was actually going to occur. So it gives us the window to operate with. Let's see if the market actually plays ball and if those positions come in to align with that. But certainly the timing, the window that we're in is favorable for a low. So it is just a case of a little bit of patience, I think, over the next few weeks.
Yeah, and I think just to for those of you who might be watching this session for the first time, obviously it's all covered in the course that accompanies this platform, but the commercials are the main drivers, and that's the group of players that we want to look at, and that they will be driving the moves. And
the main driver when we're coming to changes of trend. The beginning of something, if we're anticipating the beginning of a new uptrend or the beginning of a new downtrend, etc., commercials are generally the lead positioning for that going into something new. Once it develops, we sort of would switch attention more to the non-commercials because they'll be sort of confirming that yes, we're now all on board. But beginning something, it will be the commercials typically that start the race off. Switching into our traditional currencies, there was to say last week, last Thursday, we've seen the big moves. We've seen a lot of risk on. We've seen the equities rally. Seen pretty much all the currencies rally, and the dollar got hit quite hard. A little bit of a follow through in FX, not much. We've seen a bit more into Friday, but pretty much we've done nothing all week. Looking at the data, I'll start with the dollar index first, and I'll sort of helps explain. But something I would recommend whenever you're looking at the currency data, rather than looking at one in isolation, particularly considering how strong the correlation is at the moment, it's pretty much either buy dollar or sell dollar. For most of this year, just been buy dollar and sell everything else. And in this last sort of 10 days, we've seen dollar weakness and everything else has rallied. So it's very, very strong correlation there. So I would suggest in that sort of scenario, not to just look at, the Kiwi data or Canadian dollar data and just go, oh, CAD's bullish. Look at it as a basket. Try to get an idea and a feel of what they are all doing, because it'll give you a better understanding overall. I will start with the dollar index and then I'll go into some of the others to illustrate my points. But looking at the dollar, yes.
Actually, if I can just tell people, Ray and I were just talking about this before we went live. Just for those of you who are not familiar, the constituents of the dollar index, and Ray's already mentioned this, and we'll go into it a bit more. The biggest constituent of the dollar index is the euro, which comes at 57.6%. So therefore, the dollar index is driven by the euro, and this in itself is the color that Ray's talking about. And then next up is the Japanese yen, all the way down at 13.6%. And then we've got the British pound at 11.9%. Then all the way down, well, CAD is Canadian dollar, just over 9%. Followed by the Swedish krona at 4.2 and the Swiss franc at 3.6. So you can see those currencies. And I think the surprising one there is the Swiss franc, because that, is a significant player. But you can see the correlation here between the euro and the dollar index. They're almost sort of inverses, as you'll know as regular readers of the report. We see the same turning points because of that. But that in itself is going to be very significant, the weakness of the euro, which Ray, you're going to tell us about right now, right? So
that relationship is important because, and I say, not looking at one currency in isolation. If we start with the dollar index, Positions have been fairly stable over this last couple of months. Obviously, that everybody watching will be familiar with the dollar index has had a very strong performance through the latter part of last year, and particularly through all of this year. Positions did start to stabilize. We started to see a little bit of a decline in the trend followers, those that have been heavily long in this market that you'd expect the non-commercials to be buyers in uptrends, sellers in downtrends, what they generally do. Commercials held a relatively high level of shorts. Not that it does look extreme here, but actually if we go out, it's not. It's actually down from extreme. So relatively high, but historically not at very high levels. But the non-commercials buying, they started to ease. But particularly just before the more recent peak in here, you'll see there was a bigger cut in positions from both sides, more from the buyers in here. Now, that's a bearish indication. Those of you who watch the videos over there, before the monthly updates, you'd hear me talking about the implication whenever traders leave the market. It typically is something we see more in uptrends. So after a prolonged uptrend, we start to see traders leaving the market, starting to take profit and actually coming out. And that tends to have a bearish implication in the market. We slowly start to see the market roll over and actually move lower. We've seen that in a lot of the energy markets, which we'll talk about a little bit more, but we've seen the continuation of that. But that's what we've seen here in the dollar index. Those who had been long, and it's just like taking fuel from a fire. The fire can't keep burning if there's no new fuel coming in. And that's what this is doing. So those that had been long, they're taking their profit. They're not getting short. You'll see the short positions are staying very stable. So they're just taking profit in here. So I would suggest to me, and commercials actually have stayed very, very flat. So it suggests to me actually what we're currently seeing with regards to the dollar is just some profit taking and just a correction rather than a complete change of direction. If it was a complete change of direction, what I'd expect to see is there was the longs being cut, new shorts being accumulated, and I would expect to have seen a big accumulation and a jump in here or before going into that peak from the commercials. We haven't seen that. The only thing we're seeing is some profit taking. And if it gets to an attractive level, which we're probably not at a bad level at the moment, I wouldn't be surprised if those buyers start to return again and we see the continuation of that uptrend. I think we might see something. Something I like to do is try to go back and look at periods where price action and structure and positions are similar to what we currently have to try to map out what we might do going ahead. It looks quite similar to the big move we've seen in 2014 going into 2015, where we started to see some bearish momentum to the downside in the dollar, but we didn't get a follow through in that. And we actually hung around for quite a period of time and had a bit of quite a mess in there. That's something that I think is more likely. I think the possibility of a big decline in the dollar in here is remote. I think given the positions that we see in here, I think we'll see buyers return in and we'll actually likely see dollar contained within the range rather than actually break into a big move to the downside just yet. So I'd be wary of getting bearish dollar too quickly. And one of them, another reason to back up that, and what I talked about is looking at the currencies together. And as Andy said, the euro is a significant part of what the dollar index is doing, the inverse of each other. And if the positions did look more bearish in the dollar, then I'd expect them to look bullish in the euro, and they just don't. So to be bearish on the dollar, you have to be bullish on the euro because of that inverse relationship with each other and how strong that relationship is. And looking at the data, looking at the numbers, there is no reason whatsoever to be bullish on the euro. We've had a nice little move up to that 105 area, but you can see any move to the upside, the commercials have, even at these low levels and the near 2-year downtrend, commercials are still selling it. Their long position is actually at one of their lowest levels throughout the downtrend, which is not normal as such. Typically, you'll see in downtrends, you'll see commercials slowly starting to build a long position as the market gets to lower prices. They're hedging for that for the future increase. They've been doing that a little bit to a certain extent, but actually very flat, and they've actually cut over this last few months. So they're not seeing the need. Commercials hedge future price movement where they expect the market or anticipate a market to get to hedge their own bottom line, and they don't see the need to hedge for that upside movement, and they've used the recent rally as an actual another period to actually hedge for further declines. And you can see how they've done this throughout this downtrend. You can see the increases. If we take it where we currently are, the level of shorting that they have, every time we've got into these areas, it always coincides with the peaks and these cycles on the way down, and we've just got another one of them. So the fact that they still see a greater need to be short and hedge for further downside, would suggest they don't see the continuation of this move to the upside as yet. I say this is one of the markets I want to see tonight, based off, is there a change following the CPI data last week and the anticipation maybe that the Fed will ease, which I don't think they will, but the positions tonight will confirm this. If commercials all of a sudden have cut their shorts, a complete drop in their shorts, and they've actually started to buy, then maybe we could be looking at a positional change here and a view change in the euro and the dollar. I think that's highly unlikely, but I say that's why we have the positions. That's why we look at the positions, so we know for a fact what's actually going on. Look, dollar index data suggests we've just seen some profit taking from those that had been long. It's not bearish, but it does suggest we see a retracement, which we have done. But I would view it as a retracement rather than actually a beginning of a trend change. And the euro data backs that up. There's no reason to be bullish on the euro. And it has an opportunity for traders to get short again. So I am looking for further shorts in the euro. And that's the side I would prefer to be on. Similar with likes of the pound, we did see a nice accumulation going back a few months ago prior to the drop, and into that eventual low. We've seen a nice accumulation and a big jump in commercial longs. If we just come out, typically when you see pound commercial positions on the long side, when they're spiking up above that 200,000 contract level, that's typically an area we start to get some major lows or a pause in those downtrends. So we were anticipating and looking for a move to the upside. I think that's probably far enough. I thought we could get a 120, maybe 122 from this move. I think that's probably enough for now. If we could, my view would be looking for a move to the downside again, possibly back to 110, 112. And then we'll see, we get into the new year or middle of December, we may be able to see another move to the upside. Seasonally, a lot of the currencies do start to perform quite well, turn quite bullish around the middle of December. So that's something I'd be looking for. So I would like to see a little bit of weakness again over the next couple of weeks, and then start to possibly set up lows going into sort of mid-December for a bit of a rally into Christmas. That would be a nice sort of path. So and right now at the moment we're sort of sitting in that nice window for that. Same with the Australian dollar as well. Again, as I mentioned, the correlation, we've seen the same move across with the Aussie and the Kiwi and the CAD as well. Aussie did see a little increase in the commercial buying, just a little bit at that low, but that's I'd expect that to be faded quite quickly. And again, I'll be looking for another lower high on the Aussie dollar and a continuation to the downside. So all factored in together, it would suggest that there hasn't been a change in the market. We're seeing a weekly retracement, and it's just a healthy correction before looking for continuations to the downside of this. So I'm still bullish dollar, or probably an easier way to say it is I'm not bearish dollar. I think we could be stuck in a really sort of boring range for a while, and the dollar doesn't take out and make new highs, but I don't expect much downside either. So I'm not an instant dollar bear just because we've seen that the break to the downside recently.
And if I can just come in there, you also mentioned about December. Just again, for those of you who are joining us for the first time, there is an excellent heat map within the members area here for this platform, where you can see just at a glance how you should be prepared and pre-positioned or looking to position for the following month, the subsequent month. So thanks. Yeah, back to you, Ray.
Something that leads in, and another market that I'll be looking at tonight to see if there has been a change is the bonds. So a big driver in what we've seen pretty much all years, and everybody's talking about is interest rates and the yields going up. If if they can roll over and we see yields actually moving to the downside, we'd be looking for bonds moving higher. If that would be a strong indication that we are seeing a change in the dollar, and that would have a big implication on what we would see in markets like gold and silver. We'll get to gold and silver in a minute, but positional positions are very flat in gold and silver. But we could still see a move. We could still see a bullish move based on what the bonds do. So I'd be more interested in looking at the bond data as opposed to looking at gold data. That's generally the correlation that we typically have, and that's what I'd expect a continuation of. So it might be a case that actually the gold data doesn't turn bullish, but the bond data does. And you'll just see gold getting sucked along with based of whatever where the bonds go. In this last couple of weeks, we've seen a little bit of an improvement in the bond data. If we look at the US 10-year here, we can see commercials that we have seen a bit of a jump up around these lows, a little bit of the buying, but they had a big jump in the shorts in here, which is why the index isn't responding to what looks like high levels of buying, because obviously the index is based off the net positions, and because those shorts jumped up so rapidly, that's obviously killing the net positions. But there's a little bit of an interest in buying. There's starting to be buyers. I would like to see those shorts rolling over and maintaining those longs, and I'd like to see it across the board. If we look at the US Treasury bonds, the long term, the 30-year, there's nothing to be get excited there. But as those of you who are maybe gold or silver fanatics and you're anticipating, I'd like to see is move to the upside. Seasonally, we are more bullish as we get into the year end, but we're not really following the typical seasonal pattern at the moment, and that's because gold and silver aren't following their own. They're not moving on their own of their own accord. They're being dragged around by other markets. So if you are interested in gold and silver, I would recommend that you spend a lot of time and focus on what the bonds are doing. Are they bullish? Do we see an increase in commercial buying? Do we see demand and the need for hedging in bonds? And that would suggest we could be looking at a confirmed low in bonds, and for that market to start to rally. And if that it was the case, to say I would then expect to see sort of the shackles taken off gold and silver, and we could see a fairly significant move towards the year end in those. So it's looking for the answers, but not maybe in the most obvious places. So if that's a relationship you're not familiar with, then I would recommend you take some time and actually go through that.
Can we overlay those charts? Is there any benefit in showing the overlay of those?
I was just about to say that, actually. Yeah. So
right. Sorry.
If you want to, actually probably better in gold. So what you can do,
look at gold first and then look at the overlay.
Yeah, what you can do is actually look at the bond data in with the overlaid with the gold chart. So here at the side, so you've got chart 1, 2, and 3. So obviously that's the index stage, but you can change these chart 2 and chart 3. To make it easy to see, we'll change this one. So we can go change that over to US 10-year, and we'll keep it on the commercial positions. And I would just, you can also do it with the index if you want. But if you look at areas, just to keep it really simple with regards to the net positions, to begin with, you'll see whenever the bonds have turned bullish, so the net position had high levels. That's typically a strong indication of whenever gold actually makes a low and starts to move to the upside. Again, in here we see the same in 2018, that moved to the upside. Whenever bonds turned really bearish, that's whenever we've seen that peak. And we've seen a little bit of an increase in bonds, and then that disappeared. We come in through to this year, and the bearish bond move is what then dragged gold down. So a nice understanding of that relation. Once you understand that it's there, it's sort of I would spend more time looking for answers with regards to gold by looking at the bond data as I would actually by looking at gold itself. The reason being that is if we actually go back to gold and here and look at the commercials, if you only focused and looked at gold data, you will see that there was, back in the low in 2017 in here, there was practically no buying at all in gold. Commercial buying were not in there. But it's understanding that relationship with typically just gets dragged around by what bonds are doing. we did see a strong accumulation and a lot of buying from commercials in the bond market, and gold bottomed out and rallied along with bonds. So we could see something similar to that. There is no interest at the moment on the commercial long side, or very, very little interest in the commercial long side. Shorts are being cut, which is increasing the index because their net positions is going up. But it's going up because of a lack of selling, not because of an increase in buying. The two are not the same. So open interest is at a low area, but there's no desire for anybody to be long in gold here at the moment. So keep your eye on what the bond data is doing. And it's because the bonds did rally last week is why gold and silver sort of had that jump up. And if we can see a continuation of that, then I would, if the bond move, then I would expect to see a continuation of gold and silver to the upside as well. But it's the bond data is just improving. You definitely could not say that bonds are bullish. But it's what will allow gold and silver and have allowed, and they have allowed gold and silver sort of to have that bit of a run to the upside. But whether it's sustainable or not at this point in time, it looks like it's not. But if we see new buyers coming in, maybe we can see a run to the year end, because typically December is a good month for both. But it is reliant on other markets at the moment.
Yeah, and also as the market timing report shows, I update that super macro pitchfork going all the way back to the 1970s, and you can see how we hit the median line in that, and that's been providing very strong support. And of course, that's been the launch point for significant moves up from there. So there is the geometric side of trading is suggesting that we are in an area of strong support. Around about 1630 is the strong support area, and we are banging off that, and we continue to pop up. So watch this space. Still yet to be confirmed, but the downside is possibly limited at this moment in time on gold.
Into equity positions. Just looking at the Dow here, the Dow's been the strong performer over this last number of weeks in the equity front. But I think we're getting towards the end of the exhaustion of that move. The fact that it's only been a very small handful of stocks is something to be wary of. It's obviously the Dow only has the 30 components in it, and the type of stock that was within the Dow is why we've seen the Dow outperform. But the fact that it's just it, and it's not sort of wider spread, seeing that momentum and that move to the upside would suggest it's short term, and we are looking for a continuation to the downside. We've seen commercials, a little bit of hedging previously at previous lows was a lot higher. The buying is a lot lower than what we've been at recent positions, similar to where we currently are. So I would be looking for that move to come to an end in the not too distant future, and actually looking for continuation to the downside. Again, December is a more bullish period, and we might, depending on where we can go from here, it's similar to what I talked about with the currencies. I would like to see us a little bit of a decline over the next couple of weeks, which might give us a little bit of a leeway to actually move higher into the end of December. But I think the likelihood is when we get into 2022, we'll see into January, I think we'll see a decline again to the downside. Whether we make new lows again or not, I'm not sure yet. We'll see where we end up in the mid-December. But I do expect further weakness to come in the not too distant future. Something as well that's of interesting to see is the VIX data. We're starting to see a little accumulation on the VIX, the commercial buying in here. We see the index moving higher, the commercial buyers coming back in here in the VIX, which VIX is typically an insurance policy, if you think about it, if you're not familiar with it. And typically when you see commercial hedging, commercial buyers in there, it's insurance. They are use it as protection. They see uncertainty ahead, and uncertainty with regards to equities typically means moves to the downside. And the fact that we start to see accumulations from them is generally when we see a move up in the VIX, and moves up in the VIX typically lead to declines in that. So they're just starting to return again after the recent move to the upside, or the recent positivity in equities, but they're just starting to come back in again. So that's the threat of the possibility of decline. Not too distant and not too far away, which fits in with what I was just saying about there with regards to the Dow. Energy markets, we just close these down. Energy markets is something that everybody likes to talk about because it's always in the news. And that generally is a rule of thumb for me is a cue to not have anything to do with it if it's in the news. If it's everybody's talking about it now, and it's gone as far that it's sort of mainstream news. It's on BBC for example. That it's generally way too late for whatever move they think they're actually talking about. But if we look at the positions, what I talked about earlier with regards to the dollar index, traders leaving a market typically has a bearish implication on that market. We've seen an extreme example of that in crude oil because traders have completely disappeared. Open interest is at very low levels. You can see, and it's been going on for quite some time. As early as last year, we've seen a big decline in the positions, and it's continued right through the vast majority of this year. And it creates uncommon price action and movement in here, and it's now got to the point where we're really stagnant, sort of stuck around that $86-87, and it's not the kind of price action and structure that gets me excited. It's not something I haven't traded energy in here at all. If you're an energy trader and you're always in it and you know it inside out in terms of the movement and when it moves, etc., that's fine. That's saying nothing. Keep doing whatever you like to do, but looking at the positions in here, it suggests that there is very little interest. Whether it's because of the traders don't want to put money on the line because of uncertainty, we may see spikes. Generally, when you see low levels of interest like this, does leave a market more susceptible to spikes in either direction, quite erratic because it's easier moved. And again, that's another negative for me. That's not the kind of market I want to be in. But the general implication of this is we do see a market drift lower, and if it stays like this, if positions stay really flat and stable and stagnant, then the likelihood is we get stuck in a range. Very similar if we look at what the 18 oil has done. The ULSD, if we look at this, you can see certainly towards the end of last year, there's a big positional change. Positions at much higher levels historically than what they currently are. You see a big drop down, and they've been fairly bit of an increase through in here, but generally a lot more if we look at sort of that window in there. If we look at those two periods, positions certainly look different from after that than what they typically are. And we've seen a change in how the market has behaved. So it's important to take that into consideration rather than just looking, we've been in an uptrend, so let's just keep going with the uptrend, or the uptrend is ending, now we're going down. The positions are, particularly down here in the non-commercials, they're fairly flat, they're stagnant. The longs haven't moved, shorts pretty much they're practically at zero. There's not much interest in it, and you typically end up having a market that does that. And again, that's not a market I'm particularly excited in trading. If you like to trade ranges, again, work away. I have no problem with that. But if you're a trend trader, if you're looking for the next big move, when you see markets with positions really stagnant, really flat, it's of no interest. We'll typically be stuck in a range. We might see that with regards to dollar index. As I mentioned there earlier. So energy isn't something I'm massively excited by. It's the lack of open interest. It's the lack of interest in the market. It's the interest that causes the movement. It's the positions, it's the buying and the selling, and we don't have that. So any move are likely to be short term. We see little spikes, some good days in crude, and just come straight back in again. And it's not the kind of conditions I like to trade in. Natural gas is the only one that has some sort of semblance of normality to a certain extent. There's a little bit of interest in it. We've seen a little bit picking up on the commercial side recently, but again, going back historically, we're at low levels. It's not historically where you'd expect us to be. But there's been a little bit of interest, particularly on the commercial long side, particularly, and you can see how they were hedging for moves to the upside in the recent low, and they've continued to do that. And we've seen more of a sort of aggressive cycles, and that's what happens when are more likely to happen when you see low open interest. But it gives you something to possibly aim for, and the fact that commercials have been hedging for that move to the upside, there's a possibility we do see a further upside in here. But again, it's not something I'm massively excited by. But if you are of interest in energy, I would suggest natural gas in terms of is likely to give us much more movement in there to actually aim for. Wheat looks relatively bullish. Again, we're heading into a slightly more bullish period typically has a better December. It's not a very strong period, but typically a bullish bias going into December. Commercials have been buyers over this last few weeks, and we're starting to see, as I say, that accumulation. They're cutting the short side, so there's an accumulation here as we sort of build at this level above that 750 area. There is a possibility we see maybe something like this. It's not something I would get massively excited by. We might see something move like this and then see that decline as we go into the new year. Because yes, we've seen an increase here, but ultimately we are seeing a decline in positions generally. So any move out is expected to be short term, possibly in just as part of a wider correction like this. And then actually looking for continuation to the downside from that. So not anticipating a big move in wheat, but it does look like they are certainly hedging for that move to the upside. So possibility of a little bounce here in that seasonal period into year end in December, before then declines as we get into new year. On the more bearish side, certainly corn looks that way. We've positions fairly flat, but you see a little bit of a bearish bias on the commercial side. The trend followers haven't got anywhere near the buy level. If I just turn these off so we get a look at that, we don't see anywhere near the level of buying coming in that we've seen previously, and these moves to the upside, no momentum in that. They're actually starting to leave again. So having seen that nice move to the downside, that retracement back into 700, I'd have a bearish bias in corn and looking for that move to continue to the downside. A few people have asked me about coffee. We see a big interest here in terms of the index levels. They're all at 100% in here. And is it a time to be bullish coffee? And my simple answer would be no. The reason being is actually, if we go back, I take this out so we can't see the index up at this area. Again, this is another market where we've seen a large decline in positions. Commercial shorts, commercial longs, the non-commercial longs, the trend followers who had been buying all the way up, as you'd expect them to be buying all the way up. When those buyers start to leave, or if they start to leave, that has a bearish implication, as we talked about with the dollar index earlier. And we've seen a big change here before the actual peak was made. Traders starting to leave that market. So we stuck within a range for a while, but traders continued to leave the market, and that has, as I say, a bearish implication. So the likely move out of this range was to the downside, and then waiting for that. Certainly, how I would try to position myself forward by waiting for a break and looking for continuations after the break. If we go see where we currently are at now, we've got the decline with traders leaving, and we've got the big jump, this big acceleration from the index up to 100%, which is why they say we're right across the board and all the indexes 36, 18, and 6. But what has caused that? That is more caused because of a cut in shorts. So, and that's not bullish. Yes, we have had an increase in buying. You see the commercial buying increase in through here, but it's not at areas you typically associate with an actual low in the market and something that is bullish. We're way below the levels that we typically expect the market to actually bottom out and see a bit of a rally. What we could see in the likely scenario would be is we actually see a bit of a bounce and a correction, a bit of a retracement. But that just sets up for, or should set up for, a continuation to the downside from here. So in terms of the index short term, yes, it would suggest not the greatest time to be going short. But ultimately, we are still seeing a big reduction in positions. And the main move that was building was for this move to the downside that is now underway. And I would be more interested in trying to take more from that, as opposed to, oh, I want to be long now. The index and the positions currently suggest that, say, yeah, short now isn't the best idea. Haven't seen the move already. Let it bounce. Let's see if we can get a bit of a correction. Then it'll look to be on the short side. So bearish is actually my view in coffee and a continuation of that move. But let it bounce first.
So Jan, coffee, historically gets hit by frosts this time of the year and creates the odd panic spike up. But the overwhelming trend there is down.
Yeah, so it's a really, really good example, because it's not typical that we see positions move like this, but we've seen a lot of it this year. In terms of, we've seen a lot of this, traders leaving markets, and it takes a long time, sort of a slow burn, and eventually it sort of all comes at once, like that. I say it's not something we see a lot of, and then all of a sudden this year we've got it everywhere.
Right.
But it's understanding what that actually means, and because it's across the board, it's more of an implication that is what we're going to actually see, a bearish implication. Whereas we've seen a decrease in the dollar just in the non-commercial longs, which suggests more that profit taking as opposed to all the traders actively leaving, which suggests it's why I said it more likely to be short term rather than an actual trend change like what we're seeing here in coffee.
Yeah, and whilst we're on the softs, anything showing on sugar or cotton? Cotton is particularly interesting because we've got this situation that we forewarned our readers about the Mississippi, drying up a little bit now, and it is getting a bit more water in it, but it's still a long way short. So that's creating a supply chain problem. So just wondering, obviously sugar's not directly related to that, cotton is, but we did have a question on sugar as to if there's anything there that comes to mind. Also, just we did look at corn and wheat. Beans are worth a quick look at as well. Again, partly because of the Mississippi situation, but also we did have some very, very big cycles. For those who subscribe to the grain reports, you'll have been aware of those cycles, and they seem to be playing out pretty well.
Yeah, looking at sugar first here, we can see it's a similar range to what I just talked about there in coffee, but a much more prolonged one. Again, this is what happens. Traders leaving a market, positions getting stagnant. We don't see the continuation of what we were previously doing. So the fire from the trend previously is gone. And we're seeing this range. The bias would be to the downside, whether you want it to be aggressive. We're at a nice level of resistance here, where you want it to actually be aggressive and looking for reverse from the top of this resistance in anticipation of that move to the downside would be one way. We can see commercials actually increasing shorts at these levels. Again, low levels of positioning, but that's what they're certainly planning for. Non-commercials not doing very much nothing in here. The easier trade probably would be looking for that range reversal, because it suggests the moment we may not be in a position for a break and a decline to the downside. But even if you get a reversal from there, possibly down into that 1750, still be a nice area. And a sort of personal viewpoint, whenever I'm looking at areas like that, looking for a confirmed reversal, maybe even a failed attempt to break through and a return inside areas, like things like that, from regards confirmation of actually of a move. But certainly bearish, similar to what coffee is suggesting, and we haven't got the beginning of that move to the downside just yet. Cotton, you mentioned. Let's take a look.
And whilst you're bringing cotton up, one of the things is several of you are familiar with the work of W.D. Gann. And of course, he was a big forecaster of cotton, and he was able to tie up the cycles with the Mississippi situation as well, and the floods, and therefore the impact, and the cycles, how they impact both the markets and weather at the same time. So that's pretty much what we're doing. Obviously, we don't shout too loudly about it because people just want to know what the end game is. But this is very interesting for those of you that are students of the work of W.D. Gann.
Position wise, again, it's sounding about a broken record. Traders leaving the market prior to this, and we've seen the decline from it. Interesting, over this last few months, we've seen the commercial sort of return more on the commercial side. Certainly, the positions generally returning a little bit just over this last couple of weeks on the non-commercial front, but their longs very, very flat. It could be a case of they've got too short too quickly, and here we've got that bit of a bounce, and certainly that factor with the commercial buying as well. There's enough in there for a bounce, which we're seeing, and possibly a little bit higher in this. Are we actually seeing a change? We're not. Oh, sorry, wrong one. We're not seeing any non-commercial buying coming into this. I wouldn't be looking at it as a trend change yet. You can possibly get a little bit higher, but my view is probably we'll see a continuation of the current downtrend in through here. So wouldn't be getting massively excited. but we could be possibly near nearing a low 4, but just not yet. A little bit higher. Let's see if we can get a push to the downside again, and then maybe set up something, but still bearish with the downtrend for me. And the beans, let me have a look at soybean. I definitely am a broken record now.
Yeah, I see.
Yeah, this is not what you want. If I open the charts and the cut data, and I see this, and I see price action, or the positioning is really stable. It explains why we've got this, why we've got movement like this. And looking at a market like that, I wouldn't want to be involved anyway. It's typically just again, it's not how I like to trade, but it helps to explain why we're doing that. There was a little bit of an increase going back a couple of weeks. We've seen the commercials starting to be buyers within. I don't mind ranges. In terms of if we can get an indication from the data that we can anticipate a break, like we've seen with regards to coffee. Because I do want to see breaks from ranges. I do like to trade that, but I don't typically trade a range itself. There was a little bit of an accumulation, particularly on both sides along on the short, but more on the long side, and more aggressive on the long side, particularly in this low. We've seen a little bit of a move follow from it, but positions have disappeared, so they haven't followed through. If we'd seen a continuation of that buying as we stayed within that range, would have been a nice indication that commercials were anticipating that break to the upside from that, which obviously would have had a bullish bias. But as soon as we started to see a little bit of an increase, those positions disappeared, and we're now sitting at very flat, stable areas. So I wouldn't even have a bias from what we're currently seeing, other than the fact that because of the continued disappearance of traders is we'll eventually roll over. People will get even more bored, and we'll see a rollover of it. So a gentle rollover, bearish bias, as opposed to any really clear conviction of what's trying to do.
Great. So I think copper we talked about earlier. Ray, what's
yeah, there's interesting positions in it in terms of we've seen a lot of net changes. So if I actually just bring up the net, just so we can look at that area of it, and we can see here that the net has switched, where the commercials have went from being net long to net short, so they've crossed through zero, and the non-commercials have went from being net short to net long. Net changes can be a nice indication, or a strong indication of a trend change. So commercials, or if the non-commercials, if they had previously been short, it shows that they're now actually switching to being on the long side. And if you think of it like a moving average crossover, sort of a confirmation that the trend has changed. That's sort of a simplistic way of viewing sort of a net switches. But rather than just assuming, we've seen a switch, we are now confirming that the uptrend. With any of the signals or anything that we have, whether it be the index or positional changes, etc., it's always a case of we need to look at the positions, what's actually going on. And if we look at the positions in here, we don't really see, the non-commercials, have they switched to the long side? They haven't really. It's more a case that they're cutting their shorts, and there's been a little increase in buying, but you definitely couldn't look at that and go, oh yes, they're now long, they now want to be long, they're now buying into this. We're not seeing the kind of acceleration that we had back through here. It might develop possibly, but at the moment, in order just to sort of explain what the net switch is actually, why it's happened or what it's meaning at the moment, we can't say that's actually trend followers are now piling into the long side in copper. We actually see commercials disappearing from the long side. There was a strong buying at the low recently, but as soon as we started to see that move to the upside, they've started to come out of this. So I wouldn't be expecting a big move in copper. Likely is we were stuck in here in this range. Positions are getting very low open. Another market with very low open interest in here, susceptible to short-term spikes, which we've had over this last couple of weeks, but short-term spikes, and that's it. We don't typically see a continuation and follow through of market moves without somebody backing it up, and we don't have the open interest as we're heading to zero levels on both longs and shorts on both sides of the fence here. So it's unlikely to see a continuation of that. So always important, if whether it be the indexes, lots of flashing things in here to illustrate that could be something of interest, but they're not something of interest on their own. It's an indication it's something potentially of interest, and the net switches are the same. But always go and look at the positions to actually confirm, is it of interest? And based on what we currently see for copper, I would suggest it's not.
Right. And whilst we've got this page up, the overview page there, basically what we do, for those of you joining us for the first time, I've covered it all in the courses, the extensive course, but where we see extremes that are highlighted, so the light mauve is, you've got 1%, 2%, etc. And typically that alerts us to taking a look at that particular instrument with a view of a potential down move. And
that's based on what the COT index is doing, which is this top area of the chart here. So, and this is derived from the commercial net positions, and it suggests to have a sort of a bearish bias on the market. Whereas the 100%, which we looked at with coffee, a while ago, was whatever would suggest the index is at a high level, and would suggest commercial buying, but it might not be. It could be cut of shorts, for example, or in the case of being bearish, it could be a cutting of long. So it highlights you if something potentially is happening or developing within that market. But go and actually take a look in terms of the Bitcoin micro. It is the index is at low levels, and it is because of commercial selling. The commercial selling is at high levels. So we don't have obviously a lot of history for Bitcoin micro, but it is at very high levels, and it does suggest that they certainly have a bearish bias on that market, and they are hedged for that move to the downside, and that's in line with what the index is. So you want the positions to confirm what the index is saying. The index is there as a high level sort of a wave to you, sort of, hey, come and take a look at this. But on its own, it doesn't mean buy or sell. It's a case of come and take a look at this. This could be something of interest for you.
Yeah, and conversely, like we said about wheat, that was looking slightly more bullish, and part of that is probably going to be almost certainly influenced by the exports being cut back from Ukraine with the intervention a couple of weeks ago. So you see the Chicago wheat 93, 100, and 100,
and that's a genuine increase in the index, because we are seeing the commercial longs being increased. We are seeing the shorts decrease. So that's the correct scenario you want to see in terms of a rising COT index. That's the scenario you want to see it in, not just because we're cutting shorts, which we see in a couple of other markets, which doesn't have the same implication, which is what we're seeing in coffee. It's more of a cut in shorts as opposed to actual or true buying that we're getting in there.
Yeah, and obviously, if you just collapse that there, you see, so there you've got at a glance which instruments to look at, and then what we haven't unfolded today, maybe if we go back to the wheat chart and look at the season, every one of these has its own seasonality profile, which of course we've got separately within the course.
Yeah, sorry, I mentioned wheat getting a little bit more seasonally bullish towards year end. We're coming out of this sort of a consolidation period. We're a little bit towards year end, and to say the way the commercials are hedging, we could be looking at a possible low, say historically from the 61 years tends to make a low sort of around the sort of 18th 20th of November. The sort of the true part looks to be whenever we get into the early part of December. So commercials do look to be hedging for that the possibility of that. It is sort of a short-term move, but again, that fits with the overall what I talked about with regards to chart. It looks like we have a little bit of the possibility of a bounce, a little bit of a short-term rally, which sets up a nice opportunity to be short for the main downtrend of that move, of that current market.
And again, the key way of using this is obviously the COT data suggests we might be on the verge of an up move to start with. The seasonality supports that, and of course, if you've got the grain timing reports, those DNA signals are very, very precise down to the day. The weekly cycles are very strong. Of course, the master reports go with that. So when you get all three of these lining up, you've got the odds really in your favor, and then just manage the risk as we show you within the trading course. So that's that. But also, let's have a look at the COT extremes. And this is a great trend continuation or trend warning sort of overview again in the COT extremes. So for those of you who are with us for the first time, can we just bring that up, please, Ray?
So the COT extremes is looking, it's essentially similar to what we're looking at with regards to the COT index. So a COT index is about 100% or zero. The COT extremes is is the extreme area of that. COT index looks at just a either a 3-year period or an 18-month period or a 6-month period. The COT extremes obviously looks at the full history of the market. And if we get all-time highs, and it's rare we don't have any, but this week there are none.
The 1 week
you would actually sorry.
The 1 week we want to show it, yeah.
Yeah. But that's what this is a section, and you'll see ATH or ATL in these, and that's what that's telling you is it's an all-time high, either in commercial longs or non-commercial shorts or things like that, or obviously not a high in commercial shorts, but an all-time high or an all-time low, and it will be obviously the extreme. It's for all time. It's for the entire history of that market, and what that typically suggests is exhaustion of a move. We typically get those extremes at the end of a trend. So that's what you'd be looking at when we get an extreme, is to suggest, okay, this is actually the end of this move. The things we do see flashing over here is the net switches that we're just referring to. So if we go to coffee down here, you'll see it flashing. You can see the commercials have now went long, and the non-commercials on the short side in through here. So that's what that flashing means. So it actually comes up on the chart. You know which chart to actually get to. But in terms of the extremes, it is one of the few weeks where there isn't any. Some weeks it's just an absolute. Yeah, there's loads of them going on in here. It's rare that there's none, because there's been, particularly over the last few weeks, there's been a few in crypto. But yeah, this week we don't have any in here.
Yeah, but let's just reverting to the 3 left-hand columns. Typically, we get the commercials have one direction, and the other two, the non-commercials and non-reportables, the opposite way. That shows us a sort of sustained trend. So, for example, if you're looking at something like say heating oil, you got short, long, and equally looking at Japanese yen, you've got long, short. That's kind of a normal situation. But as soon as one of these starts flipping, it suggests that we could be coming to an end of a trend, because remember the trend followers are wrong.
It's generally as I was saying earlier, it's generally after the turn. So if you think of a market and we've been trending like this,
yeah,
you would expect to get either extreme signals possibly, or COT index signals, and that we are actually seeing commercial shorting. So we typically get a trend change signal first, and then we start to get the confirmation of it via the switches. So if the commercials have, or the non-commercials have been long, if I bring up a green here, where's my marker? Oh, there it is. So we'd have the non-commercials would have a long bias, and they'll be buying, and they'll be net long. Typically after the signal comes in that we're anticipating a trend change, we'll start to see then the non-commercial positions change. From where after the turn is when you typically expect to see then the non-commercials change to be net short. So the switch you would expect to come after the actual point. So in the case of, I wouldn't be expecting to see that switch before the trend has changed. It would be a case we would have seen either extreme signals or the COT index signals or something from the data to suggest we're going to see a trend change, and then the switch data that we have here would typically be the last part of that. So there'd be a few steps in the few pieces of the puzzle, but the switch would typically be the last one.
Yeah, and of course, the key point is that we use our histograms. So, within this course, you've got all the key turning point weeks for the currencies, and then you've got the main features in the market timing report. You've got the grains, etc. So, this is where it all layers together very, very well indeed. Look at our turning point, look what the COT data is saying, look what the seasonality is saying, and then you get the net switches confirming that a trend might have, come in, but you're ahead of the game because you've got the timing signals as well. So that's very, very valuable. Thank you very much, Ray. Was there anything else you wanted to add for this session?
No, I say the main thing for me is going to be tonight. And checking. Well, I probably won't check until tomorrow. But yeah, I'm interested to see what the data has with regards to the dollar index and the euro in particular. Has there been a change in the crypto positions following the decline? Or commercials now thinking that decline is over and they're starting to accumulate in that? So looking for things like that. The bond data, is there a change with regards to the perception of what the Fed is going to do with interest rates? Do we see them starting to be buyers and coming in to be buyers of bonds, which would have a bullish implication on gold and silver going into year end? So things like that, I'm interested to see on the data, and that will be out just in a few hours' time. So tonight's data could be more interesting for us to look forward into next year, or not next
Definitely,
week.
yeah. It'll give us a good handle on, as I say, the indices, and also the VIX will give us a lot more clues as well.
Yeah.
So a brilliant session for those of you who've been with us since our inception with the platform. I hope that served as a good refresher, as well as a fantastic update. Obviously, tonight's data will be critical. For those who are visiting us for the first time, as you know, this is a monthly session. We call it the Power Session that Ray and I get together with. So I hope you've enjoyed it. Ray, thank you very much for your excellent input here. And
thank you.
And we'll see you again next month. And thank you very much, everybody. Now, I hope you found that session very useful. As you can see, it has us prepared for forthcoming moves in different instruments. Of course, ultimately, when it comes to trading, we use the Market Timer Report trading course for protecting the risk, etc. So if you want to be involved with this, where we do these monthly power sessions, and of course you get access to the platform and it's fully updated every week, then we're going to offer a very special offer for the next few days. But before I talk to you about that, I just want to show you what exactly is involved and what you get with this. And this is all part of the Master Traders course. And really, what we're saying here is that this is all part of the Master Traders course, and a whole series of information comes with it. So these are the various bits and pieces. We've been using the platform, so you've already had a look at that. Now, it's quite complex and it's very, very capable. You know, the way we analyze the data really gives us a cutting edge. And in order to understand that, we have here a full course on exactly how to interpret the commitment of traders' data. And what the smart money does, what the non-commercials, who are the hedge funds, the trend followers, the non-reportables, who are the small players, and what happens and how they relate to each other, and how this gives us very big clues. We also have our COT index in there, which you'll have seen. That needs a little bit of explaining, and it's a very valuable indicator. We can also access things like the open interest, so we know when a market is likely to be gathering momentum for an up move, or when open interest is leaving, and that actually would be more bearish. Net switches also allow us to identify potential trend changes. So this is just a quick view. We teach all that in here, and we also have a full seasonality course with seasonality data. As you've seen that already, but we actually have a separate section so you can see exactly what's going on. This, for example, this is the seasonality for silver here. These are the FX ones, the indices, the financials, the grains, the energies. So it's very, very useful, and you can see exactly what's going on. But also we have some very proprietary seasonality stuff that we've changed. And a good example here is the idea is that where our seasonality, which is in orange, gold, ties up with the seasonality that's regular. That gives us a double sort of sense of confirmation, as it were, that when we get something like this where things are not quite aligned properly, we actually want to stay away from that on a seasonal basis. So this is the sort of thing, and where this is very strong is in things like crude oil. So you can see these areas here, they align, but then we go out of sync here, where this our programs, our seasonality goes down, this goes up. So we'd be looking for these moves where they're together. So that's very valuable in itself. We also have the presidential cycles for a whole series. I mean, most of you have seen this related to the equity indices, etc. We look at the presidential cycles across a whole series of other instruments. We look at sector seasonality, and we look at crosses for the different currencies as well, and cryptocurrencies, and we bring in heat maps. So, I mean, what we're seeing here, actually, I'll just give you a preview there into the presidential cycles. So not just the regular presidential cycles that we look at, but so we're in the midterms, we're around about here, we're expecting this sort of activity. And this is a lower order compared to what we write about in the market timing report, where we cover these things. But we also look at how this impacts the dollar index and crude oil, etc. So I'm not going to show you them all, otherwise you've got them all. No, they're certainly very valuable for getting the odds on our side. We also have the heat map that was mentioned in there. That shows you all the percentages against each other, what to prepare for the next month, etc. So that's a very valuable bit. And then, of course, the big sort of pièce de résistance is our weekly time cycles. And we look at weekly time cycles across 6 different major currencies. So things like CAD, New Zealand dollar, Aussie dollar. And what we look at there, and you can see here, so for example, these are updated, and we see some strong cycles coming in this week on the Swiss. But also these are updated every month, so you can be on alert. And what this really is that these are the future histograms for these different instruments: the Swiss, the Euro, Canadian, and Aussie, etc., British pound. So these are all parts of the Master Traders Course and Professional platform. Also within this platform are all our previous monthly recordings going into deep analysis on how to use this data to really identify whether, for example, a double bottom's going to hold or whether it's going to go through. There's lots of tricks, and you get this information by diving deep into the COT data. So there's an awful lot to this. So there's a couple of years worth of these recordings you can watch and learn from. Now, what we did do was we about 2 years ago we presented this at a live event for $25,000 to a very small number of people. It was limited to 18 people, I believe, and they've all become very successful. We also use this is actually the very basis of our own hedge fund and trading, and right now we're up 33% year to date. So if this is of interest to you, what we're going to do is we're going to open up only 10 slots because we want to keep this group elite. Now, the other thing is that you can send in questions. Our members in this Master Traders Course and Professional platform group get to send in questions, and we address those questions during these power sessions. So you get to do that. You get full access to all the platform, which is updated every week. And basically, it's a very, very powerful system. So not only are we going to open it up to a very small number of you, we're also going to give you 50% discount just for the next few days, as this week we're running into Thanksgiving and also Black Friday. So if you're interested, just take a look below, and we'd love to have you on board. But as I say, it's very limited in the number of people that we're going to take on board. The platform is very professional, and I hope you've enjoyed this whole session and learnt a lot. And you also know what's going to happen to the various markets that we discussed. Thank you very much.